All right, 12 o'clock. We're going to get started here in about 30 seconds. All right, let's jump into it. It is the end of March. Last Tuesday of March, March 30th here. It's been an interesting month, which we'll talk about markets here in a second. So this is the prop trader market update. First, quick disclosure. I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and a member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. At the time of recording, I have the following positions. All longs. I don't have any shorts on right now, which might have me a little bit nervous. We can talk about markets here in a second. But I've been trying to, manage things with position sizing. I'm also taking a few days off next week. So I've been trying to lighten up a little bit across the board. So just so you guys know, there will be no webinar next week because I am going to be off on Tuesday next week. We got my dad here. He flew out to Idaho on Saturday. So just a half step back. I think you guys have been following along with the webinar for a while. I've been traveling basically this entire year since COVID hit and we shut down our Manhattan headquarter office. So currently I'm in Idaho. We're approaching the end of ski season. My dad flew out. I've been trying to get him to come out here for a while. So he's out here for a couple of weeks. I've also got a couple buddies coming out. So I'm taking some days off next week, which I'm looking forward to doing, to get some spring skiing in here at the end of the season at Jackson Hole and Grand Targhee, and I'm probably going to go up to Big Sky and maybe do a couple days at Sun Valley. So it should be cool, but there is going to be no webinar next week. I am a senior trader and registered principal here at T3 Trading Group. I've been with T3 really since 2010. I've been licensed with T3 since they've required licensing, which was in 2011. I've mentored well over 100 professional traders. Got a large group I'm working with now. Obviously into skiing, into martial arts, into all things markets. So with that said, you can email me here. I'm going to be talking about markets today. I'm going to be talking about T3 Trading Group, proprietary trading. We have retail trading here available as well. So if you have any questions about anything that I talk about today, definitely feel free to reach out. And again, here is my email address. So let's go to the charts. All right. So honestly, the month of March has been pretty volatile, pretty choppy, but we really haven't gone anywhere so much. And it depends which index that you're looking at is going to tell you a pretty different picture. And this is one of the things I'm constantly viewing. I know we've been doing this the last few weeks here on our webinar. I'm constantly viewing all of the different indices and placing them into one of three categories: bullish, neutral, bearish. It's a simple process, but I think it's a very important exercise because, one, it helps you to understand money rotation, which has been a huge theme over the course of the last several months. Is understanding money rotation, especially as interest rates have picked up. It's led to further money rotation. We've seen overall financials performing really well recently, energy performing really well recently, but we've seen a lot of these high multiple stocks. People who've been following my webinar for last year, you guys probably remember back in November, December, I was like, oh my God, I can't believe some of these stocks. It makes no sense that fuel cell is going up 600% over the course of a month or two. And now since then, we've seen a lot of those high multiple stocks, especially with interest rates rising, get a ton of money rotated out of them and into things that are financials, energy, materials, basically areas that are, more dividend players, more safety players, more value type plays. So you have a very different picture depending upon which index you look at, depending on what types of stocks that you're looking at. And that's why the first thing I do every day when it comes to part of my morning research process is I review these different indices and I try to figure out where the relative strength and relative weakness is, because it has a massive impact on the overall probability of any trade that I take. Right, so looking at the SPY right here, the ETF that represents the S&P 500, this is very obviously bullish. Right, we're just a hair away from all-time highs. Thursday, Friday last week, we had two pretty strong days in a row. Yesterday was primarily a rest day, and today honestly has been primarily a bit of a choppy rest day as well. Last two trading sessions were a little bit difficult. If you look at the Dow, which is an index that I almost never look at, honestly, because it's only 20 companies, it just does not provide enough information for me. But the Dow, basically at all-time highs. Then you look at the Qs and the IWM, you get a little bit of a different picture, right? Both the NASDAQ and the Russell 2000 have underwent technical market corrections. What is a technical market correction? A technical market correction is when the market pulls back 10%. Between 10 and 20% is a correction. More than 20% is considered to be a bear market, right? So we had this big pullback here from 338 in the Qs, the ETF that represents the S&P 500, to this capitulatory day on March 5th down at 297.50. That's a pretty big pullback, right? We're talking about a approximately $40 pullback in the NASDAQ. You look at the IWM. The IWM's pullback actually in the beginning of March wasn't too bad. The pullback that we had here more recently in the middle of March was much deeper. This is like an 11% pullback here in the Russell 2000. So initially, right, when the Qs sold off here in the beginning of March, look how deep this is. That's where your relative weakness was. And the IWM was where your relative strength was, value. And again, this was caused primarily by interest rates, right? This heavy sell-off here in the TLT correlates to a higher interest rate. And at the very end of February, we saw some capitulatory action, more or less a retest of that here in the beginning of March. And that is when the NASDAQ was making its lows. This is also when a lot of those high multiple names that I'm constantly talking about were making their lows as well. March 5th was probably the best opportunity of the entire month, as far as I'm concerned. This was the day when we recognized heavy fear coming into the marketplace. We recognized, wow, a lot of these high multiple names that I was scared about when they were going up 500% in December have now pulled back 60%, have gotten extended to the downside, had volume capitulation, had these heavy hammers come in, and then that led to great bounces. I remember, going to Lemonade myself, catching a nice trade here. This is exactly what I'm talking about, right? This is just a perfect example of a high multiple stock that got totally beaten up. This thing has a high here of, 188.50 or so, a more recent high in February of 171. And from there, you're looking at basically a straight down move, and this is because of the rise in interest rates, these high multiple names getting hit. You basically see a straight down move from 171 and change in Lemonade all the way down to $80, right? So what percentage is that? I'm not sure off the top of my head. Let's call it 60, 65%, something like that. And you just saw all these pullbacks come in. And then what do I have here? High volume, extended hammer candlestick. Honestly, the volume could have been a little bit better here, but you got heavy extension. So the space between the 8 and 21 EMA is a space that I consider to be technical equilibrium for any stock or any market that I'm looking at. And you got this stock here trading at $80 with the 8 EMA at 110. That is extended to the downside by a massive amount, like 25% or something like that. And then I don't just catch a falling knife. I don't just buy things when they're on the way down. You wait for that signal. This candle here is your signal, right? What do I know? Sellers are in control on the way down, very clearly. Look at this candle. Who's in control in this candle? Buyers or sellers? Sellers. 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 What happens on this candle? Well, beginning of the day, sellers are in control, and they rip this thing all the way down to lows. It gets massively extended into this $80 area, right? And $80, unsurprisingly, was a place that the stock broke out from in late November, early December of last year. You get massive extension down into this $80, and then what happens at some point midday or so, buyers took control and drove this thing all the way up. So by the time this candle is closing, who's in control? Buyers or sellers? Buyers, right? And I have this degree of extension. What does this candle tell me I should expect? This candle tells me that I should expect retracement, not reversal, right? I think everyone likes to use that term reversal candle, or, you know, looking for a reversal or whatever it is. I'm very particular about the language that I use in regards to trading. I think this is very important. This is not a reversal candle. This is a candle that indicates retracement. Retracement to where? Well, retracement back to the equilibrium area. From there, what happens? A couple of things could happen. You know, maybe you make a higher low and it works its way down. Maybe it gets stuck here in these moving averages, makes a higher low and works its way up. Basically, either of those could happen. I don't know. I have a much lower probability of success if I'm entering a trade into this equilibrium area than if I'm entering this trade into this degree of extension. So basically, my game plan when I was buying this lemonade was just looking for a move back up, right? And I was able to catch that. It was a good few-day swing trade there. And now what's happened since then, it gave that retracement, failed, and come back down. I have not re-entered it. I actually thought about re-entering it today. I'm 100% long, and as I stated earlier, I'm taking a few days off next week, so I'm being extremely selective right now on new trades that I'm getting involved in for those reasons. But I liked the idea of potentially going long lemonade again here. So now we're in an interesting area, because we're back down to this $80, which we know is some sort of support, but we don't have that same degree of extension. This candle told me that I probably had a greater than 50% chance of getting a move to the ADMA. That's going to be a pretty good risk reward. If I'm coming in, I think my price is below 90 in this thing. I think my average price was probably $88, $89. If I'm coming in, I got a price of $88, $89, and I think I can get a move to, at least 101 here where the ADMA is. That's $13 worth of upside. That's pretty decent from a risk reward perspective. The second time, I don't have that same degree of extension. I don't have that same reward potential here. In order for this trade to now really work, instead of relying on a retracement, which is much easier to get, I need to be reliant upon a reversal, which is going to be much more difficult to get. So we have a whole lot of these high multiple names right now, Lemonade just being an example, but you could type up, a ton of them, your fuel cell, names kind of that nature, that have retested that March low here. Now, is this going to be a double bottom formation? Is this going to be like an H pattern formation or some sort of descending wedge, which could be more bearish? I don't know. I don't know how this is going to play out. I don't have a crystal ball. I can't tell you the future. I can only tell you things in terms of the key formula of trading, which is risk, reward, and probability of success. So I can tell you, taking those longs in early March definitely had a better risk reward and higher probability of success on that retracement than here, where I am more reliant on a reversal. Does that mean I hate the trade off of 80? No, I don't. I think very broadly, while Lemonade is holding above 80, stocks that are retesting their March 5th low but are holding them and are still above them are stocks that you can be long for right now. But if they start to break those lows, you got to get out of the way, and you got to get out of the way quickly. That's risk management. And potentially, you could even be looking at a short. Question is, and this is where it gets a little bit more tricky, where do these stocks, air quotes, belong? And where they belong, and where a stock trades from the perspective of a price to earnings multiple changes as interest rates go up. These types of stocks get hit particularly hard. So I need to be constantly paying attention to TLT, which is my signal here for interest rates, right? So it looks like TLT is a little bit higher now. Interest rates are a little bit lower, so that's helping stocks like, Lemonade catch a decent little bid today. A bunch of those things have done pretty well, and we'll see. It's kind of one step at a time. So you just have to be patient. Being long versus 80 in Lemonade as an example, I think is a great idea. It starts to break that 80, get out of the way, and keep in mind you have a worse risk reward and probability of success than the first time it was here. So those are your kind of high multiple names. They're in very questionable areas here right now. They're in kind of do or die spots. We'll see how that plays out. Also keeping an eye on the FANG names. Apple, all these FANG names right now, including the Qs. So let's go to the NASDAQ here for a quick second. I said that the SPYs and the Dow are in bullish territory, but the Qs and the IWM are in what I would consider to be neutral territory. Right now, the Qs have built out into a range, right? They capitulated down here. It was looking pretty bearish, but they got back above 310. Above 310, I consider Qs neutral. Above 325, then they'll have a reverse, and I'll consider it bullish. Below 310, bearish. So right now, we're in between 310 and 325. I consider it to be neutral. You've got clear closing basis support at 310 in the Qs. You have clear resistance at 324.50, 325 in the Qs. Those are the spots I'm paying attention to. While they're in the midpoint of the range, it's much more difficult to trade. Where the Qs opened up today, where they opened up yesterday, it creates a much more of a hands-off type of trading environment where I don't want to be pushing risk as heavily because I do not have as much of an advantage from a trading perspective. And if you look at these FANG names, they're all having very similar pictures right now where they have these ranges where there's fairly clear support, clearly clear resistance. One of my favorites is Google, so we can start with Google. I love this Google chart. Even though it hasn't really been able to catch a bid too much, Google actually got upgraded this morning. To take a half step back, 2 earnings reports ago in November, Google had stellar earnings. But then they really didn't do anything. They built the base with support at 1,700 for 3 months. And they broke out a couple weeks before their most recent earnings report. They started to break out. Then they had another great earnings report. And look, Google's basically doing the exact same thing. It has now created a base at 2,000 over the course of the last 2 months. Going sideways. Makes sense that they can't catch too much of a bid, given what the NASDAQ has done. But from the FANG names, Google, maybe my favorite right now. I'm always a big fan of Microsoft as well. But Google here, support 2,000, resistance 2,100. Google starts breaking above 2,100. It probably needs the NASDAQ to start performing in order to do that. It probably needs stabilization from interest rates in order to do that. But Google starts breaking above 2,100, looks great. Holding above 2,000 looks really good. Starts breaking below 2,000, which probably means my entire NASDAQ is breaking down. Not so good. Not looking nearly as good. So that's Google there. Microsoft, also one of my favorites. Similar. Kind of built out a range here between 230 and 240. In that range right now, Microsoft's a little bit relatively weak today. If it starts breaking below 230, above 230, it looks good. Below 230, I'm getting concerned. Maybe the whole NASDAQ starts breaking down. Above 240, it looks beautiful. And maybe the whole NASDAQ, which again is neutral, starts breaking up. Amazon, also similar. Amazon, you got 3,000 on the downside, and you've got about 3,150 to 3,200 on the upside. Above 3,200, Amazon starts looking good, but the problem with Amazon is you start clearing 3,200, you just come right back into the next very broad area of price congestion that's been going on for months. Amazon has not done anything for months. But these more immediate levels are just a really important cue for the NASDAQ as a whole. And again, interest rates are important for the FANG names, though I would definitely argue it's not as important for the FANG names as it is for some of these massively high multiple names that don't even necessarily have earnings yet. They're entirely moving based on revenue growth. That I was basically calling the mini bubbles back in December. Those bubbles burst. They've pulled back 60, 70% in some instances. So interest rates definitely impact those names even more. So, there's your Amazon. Netflix, very similar story. $500 on the downside is your most immediate area, $530 or so on the upside, in between. Facebook actually has been my least favorite FANG stock, and it's performed possibly the best. This thing broke higher and is potentially trying to build out a pattern of higher highs and higher lows. Even today, Facebook showing good relative strength. So those are kind of all of your FANG names. We need to be paying attention to financials. We need to be paying attention to energy, XLE, XLF. These have been relatively strong. They're building out more wedge patterns. I don't love the idea of jumping into any of these stocks in the midpoint of this pattern as it's building itself out. I think they need more time, but we did have a great trade here in Chevron when it retested $100. Not sure if people remember, but back here I was talking about the breakout of $200 in Chevron. It led to a beautiful move. Then it again, got extended into this pullback. Pulls back from 113 to basically $100, retesting the previous level that it broke out from, and it's extended into it. That was a great little trade there, for $7 or so worth of reward, but it's also now building out a tougher pattern. Airlines. I don't like airlines as much. I think they have fundamental problems, but the technicals on the airlines have been great. Also trying to build out a little bit of a wedge. Inside day yesterday, breaking up. I know AAL got upgraded this morning, so AAL was one of my ideas that we spoke about in the morning meeting today. Actually, it wasn't my idea. It was one of my teammates' idea. They brought up this American Airlines, and it broke higher on that upgrade, and that was a nice little trade there as well. So again, the big themes right now, I do think that less is more for the moment until we get a little bit more clarity out of the Qs and out of the IWM. So I think less is more, but if you're going to err to the side of the longs rather than the shorts because of what the SPYs and because of what the Dow are telling us by still being technically bullish. And at the same time, the other major thing that we want to keep paying attention to is money rotation. How is the money rotating into the market? Where is that relative strength? Where is that relative weakness coming in? What are these high multiple names? Many of them have similar looking charts to Lemonade here. Are these high multiple names going to hold their March low areas and reverse and break higher as interest rates stabilize? Are these FANG names, and I know I didn't even talk about Apple, but are these FANG names going to break their key levels that they're stuck in the middle of a range on to the downside or the upside? The answer to that is also dependent on interest rates. That'll probably lend to whether the Qs break up and become bullish again, or the Qs break down and become bearish again. Again, right now they're neutral. So what does all this tell me when the NASDAQ's opening up here at the midpoint? Very broadly, it means I should be having a less is more approach right now to trading. I think the last couple of trading sessions have been particularly difficult. They've been particularly choppy. Sometimes the smartest approach you can have to your trading is capital preservation. It's recognizing, I don't have that much of an advantage here, so I'm not going to push it. And if I don't have an advantage trading the indices or things highly correlated to the indices, there's usually other opportunities we can go to for stocks that are not going to be as correlated. One of my favorite ideas for today was VIPs. VIPs long early. If you're able to get stock around $30, this was a decent little trade here. Go to the 5-minute chart, see this off the open. It puts in this initial pivot low here at 30. I was calling out to my team on the way up here, guys, I think we can be long versus the initial pivot low here in VIPs, and it gave a nice move. Why is VIPs moving independently to the market? It's not a stock I normally go to, by the way. TME, another one. Viacom, another one. Discovery, another one. What's going on here? Well, obviously, I would assume everyone knows now what happened with the block trades that are resulting from that hedge fund that completely blew up in a massive way. You know why that hedge fund blew up in a massive way? I can tell you, he wasn't part of my VTF. Because if he was part of my VTF, he would have known the message that I tell my traders every day, which is managing your risk is the key to success in the business. They were not managing their risk. They were leveraged to the hilt in this Viacom, which had this insane move, probably partially caused by them. I actually shorted Viacom on this day at highs. I got stopped out at, I believe, 101.87 of most of my position. I had a little bit that I caught the down move on, but my heavier position I got caught out at got stopped out at 101.87. You know, it's good for me to talk about my losses. I think it's really important also because I want to show that I'm not a perfect trader. I am not a perfect trader. I'm a good enough trader to have been doing this professionally for over a decade now. But I am by no means a perfect trader because the perfect trader does not exist, right? Everyone occasionally will get shaken out of a trade that works. I got stopped out of Viacom at 101.87. A few days later, the stock plummets to $39, right? That's part of trading. It's part of risk management. It's part of working in probabilities. When you are working in probabilities, which is what you do as a trader, it inherently means that anything can happen. That's one of the things I know for sure about markets and trading. Anything can happen. So you should never think to yourself when, I've got this long position on, it's against me, it's got to come back. It doesn't got to do nothing. Nothing has to do anything in the market. A stock can remain irrational for longer than you can remain solvent, right? I could have easily made an argument. I did make an argument, even though I didn't take the trade, that GameStop was ridiculous at $120. I felt that the thing belonged at about $40. But even if it was crazy at $120, one day pre-market it was trading at $520. So I can't just be short GameStop at $120 and say, oh, this company makes no sense. Because by the time it's at $520, I'm out of business. So you're trying to, first of all, counter trend trades are hard money. Let me just throw that out there. Sure, I would have looked like a genius, and honestly, if you want to trade where I did look like a genius, because I can throw a good one out there too. GameStop, when I put in this high here at 348.50, I shorted, I believe, 346 that day, and caught that entire intraday down move to 232.60. What's this low? No, 172 in like whatever that was, like 15 minutes. See, so I, got lucky. I got lucky here, and got a little bit unlucky here. The counter trend, counter momentum trades are significantly more difficult to be consistently profitable in than just going with the trend. As much of a genius as I would have looked if I could have not gotten stopped out at 101.87 and gave it an extra 15 cents and caught this down move here, I would have looked like a genius. That money is so much harder to pick this absolute top than it would have been to just be long on some of these breakout and uptrend patterns that were coming in the whole way up. That's so much easier money. If you're doing consistent top picking and counter trend trades and things of that nature, you're going after the hard money. Your reward is inherently limited. Your probability of success is much more difficult. Trade in the direction in which stocks are moving is much easier. And honestly, the reason why I shorted Viacom here at all was because I caught this top in GameStop so perfectly that I was like trying to almost show off to my team, like, guys, I'm going to short this Viacom now because it's going to be the top, ha ha ha. Which is, I was actually right, but I lost money, right? So just a whole bunch of things to consider. I don't want to get onto too many tangents here, but we start with the big picture game planning. We look at all these different layers of probability. We look at degrees of extension. We look at the different indices. We look at money flow, money rotation, relative strength, relative weakness, risk reward. We put all of that together. It's like a giant jigsaw puzzle. You put all of those pieces together, and now you have a nice picture in front of you. And based on that picture, you can then execute into the market and have an understanding of probability. So that is, really what we're trying to do on a basis. I see here someone in the YouTube made a question. What moving averages are you using? So the primary moving averages I use are the 8 and 21 EMA. The space between the 8 and 21 EMA is a space that I consider to be technical equilibrium for any stock or any market that I'm looking at. So Viacom, which I just happen to still have up, when Viacom was at $102 just about, and the ADMA was at about $86 or so, $85, that I would say that this stock is extended from its equilibrium by about $17, or in this case, extended by about, because it's a $100 stock, at that time, it was extended by about 17%, right? So when I see a stock that's massively extended to the upside, it tells me I don't want to buy it. It also tells me I don't necessarily want to short it. Because if I'm shorting it, I'm jumping in front of potential momentum. And a stock that's extended by 5% can become extended by 10%. And a stock that's extended by 10% can be 20%, right? That's because of momentum. The definition of momentum is the greater the price, the greater the demand. So literally enables for irrational price movements. But it's something you pay attention to and you wait for a signal to actually take the opposite side of the trade, if you even want to take the opposite side of the trade, which again is what I'm saying is kind of more difficult money. Someone asked, what is your win-loss ratio? I don't know, actually. It's not a statistic I really keep track of. I know that I am wrong more often than I'm right. Almost all of the best traders I know are actually wrong more often than they're right. But your risk reward makes up for it, right? Maybe you're only right 25% of the time, but if you're making 10 times your risk every time you're right, you're still consistently profitable. But it's not really a statistic that I honestly keep. So yeah, and then when the market is not really giving us, it's showing us, more difficulty, like where the IWM and the Qs are, it means less is more, be a little bit more selective, and go to things that are trading as one-offs. I can tell you one thing for sure, Viacom is probably trading at a much lesser correlation to the market right now than Apple, for obvious reasons. All right. Okay, so I think we covered the charting for today, so that's kind of this week's update. Let's talk a little bit about T3 and what we offer here. So T3 Trading Group is traditionally a proprietary trading company. We are a FINRA registered SEC broker-dealer, so regulated by FINRA and the SEC. We engage in professional proprietary trading. That's our traditional business that was always primarily equity focused. We've expanded that business. Now we're equity focused. We trade equity options. We trade futures, options on futures. We also have retail trading, right? We have retail accounts that compete with the major retail brokerages that you've all heard of. Your Schwab and E-Trade and TD and Robinhood and whoever else. So I say we have significant advantages in all those areas. T3 Trading Group is one of the largest proprietary trading firms in the United States. We have hundreds of licensed professional accounts. We have physical offices, mainly on the East Coast. We've taken, honestly, some of our physical offices offline because of the COVID situations, kind of just wasting money. Manhattan's where our headquarter office is. Over the course of the last year, everyone, myself included, has been trading remotely using our virtual trading floor. That's probably 50% of our traders were doing that even before COVID hit, so that's been no problem. T3 Trading Group, again, is a registered SEC broker-dealer and member of FINRA SIPC. So all of our professional traders have to be licensed with an SIE, Security Industry Essentials, and Series 57 examinations. So you got to pass those two tests. We provide study material through our partners at Notman, and we'll sponsor for the exams. The retail accounts, if you're like, oh man, I took that Series 7 back in 1974, I have no interest in taking any one of those tests again, then you might be more interested in a retail account with T3. Our retail accounts use Sterling Trader Pro, it's standard Reg T margin. T3's advantage in the retail space is basically direct market access at a low commission cost. We do not sell your trading orders out to HFT firms, either for the professional or the retail accounts. That payment for order flow has become a big topic recently. I've been talking about it for a couple of years, but because of the GameStop Robinhood fiasco, it's finally recently started to become a much broader topic, and people are starting to learn what I've been talking about for a long time, which is if you trade for a commission-free broker, it is accurate that you're trading commission-free. It is not accurate that you're trading for free. right? Everyone is in finance to make money. And it's not like these brokers just woke up one day and said, out of the goodness of our hearts, we are going to give trading to the masses for free. No one said that. They said, how can we disguise the way that we make money so that volumes increase even more and we can make even more money? I got it. Let's not charge a commission anymore, but let's sell out your order flow so you're getting a worse pricing on your trades, which I think is a little bit nefarious, and it's also extremely expensive from my understanding. Exactly, Paul. It's extremely expensive if you're an active trader trading through a commission-free brokerage. With T3, I'll be honest with you, T3 is here to make money. We charge a commission cost, but it's very straightforward. You know what your commission cost is. It's very low. On retail accounts, we're usually doing about 0.2 of a penny, and it's very low, and we don't sell your orders out. So it's very straightforward. There's nothing really nefarious about what we're doing. There's a lot of other benefits. So again, that's the retail side. We also have professional proprietary trading accounts. It's more our traditional business. On the professional side, we have 3 trading softwares, Lightspeed, Sterling Trader Pro, and Wolverine, also known as WEX. On the retail side, we only have that Sterling Trader Pro. Again, I said this before, we have multiple asset classes now, so reach out if any of that interests you. We have equity options as well. Personally, I'm an equity trader. Most people I speak to on a retail account, many of them are options traders. And honestly, if I was in a retail account, I probably would be an options trader too. And that's because options have natural leverage that standard equity does not have. And there's obviously a huge benefit to that. As a professional trader though, T3 gives me so much capital access. We typically start by giving traders 20 times their account for day trading and 8 times their account for overnight positions. So basically, someone who's a $50,000 account has access to $1 million for intraday trading. That's what I'm a professional account here with T3. My thought process has always been, why do I want to trade options which are a less liquid product and subject to time decay just for capital access when I already have as much capital access as I could ever want? Again, retail account, a little bit of a different story where I think options make much more sense. Or if you implement complex option strategies like calendars, spreads, or you're selling covered calls for hedging and for cash flow purposes on your swing positions, that all makes sense for me, and we can put all that together for you. But the biggest advantage of T3, I think, it's not just the capital access. It's not just the direct market access. It's not just that we're not selling your orders out. It's that you're joining a team of like-minded individuals. I'm managing a very strong group of professional traders. Some of these folks have decades of experience, former fund managers, floor traders, pit traders, and others that are at the entry level, which is fine too. Trader development is something we take very seriously here. I conduct a morning meeting every day at 9 a.m., an afternoon meeting every day at 10 after 4. Everyone on my team is very forthcoming on information. There's optional training programs when you first get started, and you have access to that all just because you're trading with us. The way we view it is that we as a firm here at T3 Trading Group, we are incentivized to see all of our traders succeed. Because if you are succeeding as a trader, you're happy, you're making money, that means that T3 is making money, we're happy, it becomes a win-win situation. So I do whatever I can to help the traders that I'm working with be as successful as possible. And you'll have access to all of that just by being with us. Question here from Menta. How many hours of study for the 2 exams? It's a great question. I'm not sure on hours exactly. If you have 0 previous experience taking series type tests, I usually recommend about 2 to 3 weeks of study for the SIE, followed by about 3 to 4 weeks of study for the Series 57. So total, you're looking at about 1.5 to 2 months in order to become a professional trader and get through that licensing. Again, if that's not something you want to do, we do have the retail account option, but I do think that there are some significant benefits to having a professional account where we're giving you this degree of capital access. So this degree of capital access is without a doubt a double-edged sword. Let me start by saying that. If you put 20x into a position, and that position goes up a lot, you're going to make a lot of money in a short period of time. But if you put 20x into a position and that position starts going against you and you don't have a game plan in place for risk management and money management, that is a fantastic way to lose a lot of money in a short period of time. So as a professional trader with this degree of capital access, it makes risk management, which is already the key to the business, even more the key to the business. It makes it even more important. Risk management is the key to the business in trading, particularly with this degree of capital access. I cannot emphasize that enough. But this degree of capital access may allow you to implement certain types of trading strategies that are not possible in a retail account. I don't really concern myself too much with how much a position costs because of capital access. I am entirely concerning myself with risk math, meaning if I want to buy 1,000 shares of Tesla right now, I go and I press the button. I'm not sitting there saying to myself, all right, well, let's see, where is Tesla trading at right now? All right, well, I want to buy 1,000 shares of Tesla. It's at $624.30. Where's my calculator? How many dollars is this going to cost me? Blah, 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 blah. I don't have to be concerned about that as a professional trader. What I have to be concerned about is if I buy 1,000 shares of Tesla and this thing starts going down, where am I taking my loss? So it's the risk math that I'm constantly doing as a professional trader. And again, that opens you up to certain types of strategies that may not be possible in just a standard retail account. So if you're at the entry level and you're just getting in this business and you want to learn, T3 Trading Group's a great place to come. And if you're an experienced trader, T3 Trading Group's a great place to come. One, still because of our support structure, our team environment, but also because of the capital access. T3 is a very well capitalized company, as far as our proprietary trading operations go. If you want to put $2 million into a professional account with us because you want access to $40 million, we can probably make that happen. Reach out to me and we can discuss it. Again, here's my email address. And you can get all this other great stuff for free. My VTF room, Scott Ruther's VTF room, my training program is not even listed in this slide. You get Red Letter All Access newsletter. I think they changed the name of that now to something else. But you get all that for free. Again, why are we just giving away all this stuff? All you need to have is a trading account with us because we want your trading account to be successful. Like I said before, your trading account is successful, you're making money, we're making money, everybody's happy. So again, email me. I think I said this in a previous week. I really do think that T3 has the best offering that's out there. If being an active trader, if being a professional trader is what interests you, this is what you want to do, this is your passion, this is what you enjoy, same way it's my passion, it's what I enjoy, this is where you want to be. So reach out to me, here's my email address, and I'm going to dive back into my trading. So I hope everyone has a great rest of your day. Again, next week, I'm going to be taking a few days off, getting some extra skiing in, hanging out with my dad, a couple of friends out here in Idaho and Wyoming. So there will be no webinar next week. And that's it. I hope everyone has a great rest of their trading day. And I will see you all in 2 weeks, unless you jump in and become part of my team, in which case I'll see you sooner.